Hey Eric, how are you?
Morning, Adam. Good. How you doing?
Good. Thank you all for joining us. Eric, how's it by you? Have things calmed down with the fires and the mudslides and the 10 plagues that you every now and then get in California?
Yeah, all back to normal.
Yeah, we had a pleasant, relaxing President's weekend, except for the cold, the snow, the rain, and the ice. Other than that, everything was great. But I had some friends who went down to Florida and they had a tough time getting back because of all that. So they were a little stressed out. So, I'd rather kind of be stressed out up here than have to be stressed out at the airport. But nevertheless, I am going to subject myself to that because the Roaring 2020s tour goes on. I'm going to be in Las Vegas tomorrow and then Houston the day after that. So I will be on the road and communicating. Max is with us and with his usual attentive position. Eric, I was thinking, we talked about and we showed folks a prototype for Maximus, the cryptocurrency that features Max as the as on the coin. Maybe what we really need to get into is producing large language models. Uh, you know, uh, Elon Musk just came out with Grok 3 or something like that. Maybe we come up with Max 1, Max 2, Max 3 and get into that business. There's a lot of opportunities here for our entrepreneurs, and you and I are entrepreneurs. But speaking of entrepreneurs, let's talk about the economy. Let's talk about what that's all doing in the financial markets. What's your sense, Eric, of some of the developments of the economy? You wrote for this morning about retail sales, and obviously that looked like a really bad report. But when in doubt, blame the weather, or is there something else we should know?
Yeah, I thought it was curious that a lot of people were anchoring on the retail sales print, yet stocks were up on the day. And clearly markets were looking through it for some reason. So from what we gather, what looked like a pretty rough retail sales print, nearly down 1% in nominal terms, and much more so in real terms because we actually had a good amount of CPI goods inflation, was probably a lot of seasonal adjustments. And we've had issues with retail sales and some of the other economic indicators that are consumer related post pandemic, with the seasonals are struggling to catch up. But in non-seasonally adjusted terms, it was the same drop off in January we've seen for the past 2 years. So a lot of spending happens in December,
Right.
it drops off in January. It was less than we had last year on a month over month basis, less than 2022, and just a bit more of a drop off than 2023. So spending looks overall pretty good, up around 5% year over year if you average out like Redbook retail sales and the non-seasonally adjusted retail sales print from Friday. And then we had really good industrial production data. So by and large, I don't think it's much to worry about.
Some of the strength in that production numbers, there's industrial production, and then within that, there's manufacturing and utilities and mining. And the utilities number for output of utilities confirmed the weather issue, right?
Yeah, there was a ton of energy demand. So we had that winter freeze. I mean, I was kind of anchoring on the LA fires, but like the winter freeze was probably a bigger impact. But yeah, I mean, it was definitely a January month over month increase for utilities and energy. But by and large, we've been seeing like higher highs
Right.
in energy usage and utilities. And that's probably not something that's slowing down with
Hmm.
the data center demand. So that's probably a good story for industrial production for some time to come.
Yeah, and I guess we'll keep watching the labor market. So far, so good with initial unemployment claims and continuing claims. It will be worthwhile watching initial claims in the Washington, D.C. area. I'm not sure. I guess if somebody gets fired, they certainly can go and file for unemployment claims. If they resign, I don't think they can, right? From what I recall. So
Yeah, I'm curious what it entails with like, I know certain agencies have different
mhm,
protocols, but I think federal workers would especially be quick to sign up
yeah.
and do claims as opposed to private sector workers who have severance and all that stuff.
Yeah, on the other hand, if we do get some weakness in federal government employment, The manufacturing sector looks pretty good. I guess I didn't see the New York. Did you see the New York State survey today?
No.
Yeah, we'll have to look at it. But the New York State and the Philly surveys come out for February. The January numbers for all five surveys look very strong. So it's conceivable that the manufacturing sector might start to show some signs of life. It hasn't been doing so since late 2022, and there might be some job gains in the manufacturing sector. Though I would think that productivity would be an important source of how things pick up in that part. Let me turn this off.
For a quick, I just checked the New York numbers. So it jumped into positive territory, like had a five handle on it, and largely driven by new orders, jumping into double digits. So it was a good print.
Yeah, well, our attitudes towards to New York is it's awfully volatile, and so when it goes in a direction we don't agree with, we point out that it's volatile, and when it goes in the right direction, which is going now, it's good data, but it's encouraging. We'll see. I mean, it is very volatile data, and Philadelphia seems to be a little bit more stable. So when we average the two of them, we get a better read on the national purchasing managers. But of course, all five surveys do an even better job of that. But this is an early read for February, and so far so good. What else can we talk about? Well, let's talk about the stock market. Stock market. I was on CNBC this morning, and Joe was saying that a lot of strategists that have been on the show recently are all concerned about all the chaos in Washington, and he said good things about our ability to kind of stay calm in those situations. But our position on the chaos with regards to tariffs is that it's reciprocal, not the retaliatory tariffs, is the way the administration has described it. And the Smoot-Hawley tariff was retaliatory, and it led to retaliatory tariffs and a trade war. Then in 1934, they passed the Reciprocal Tariff Act, which Congress said, we're too dangerous in this subject. Let the president handle this. And now they kind of regret that they gave that kind of power to the president. But the president does have that power. And it's interesting that the administration has kind of talked about reciprocal tariffs, because that's what happened in 1934, is that the Reciprocal Act was to let's lower them together. So our position is that it may not end badly. It may end up without a trade war. It may actually end up well. And if we slap on reciprocal tariffs and postpone them for 30 days, and that gives both sides a chance to negotiate, then we may very well see that this isn't the awful negative development that some people are concerned about. And then, of course, people are concerned that if we're going to lose the government employees, and if some of them are rather important in sending out Social Security checks or maintaining nuclear warheads, that could lead to some problems. But again, this is an administration that's very much into deal making. It's very much into kind of quid pro quos, and it certainly is flexible. Maybe that's one of the reasons uh, investors are saying they're seeing chaos out there, is because the president does seem to change his mind a lot. Remember, the China tariffs were 60% now during the campaign. Now they're 10%. There's going to be 25% on Canada and Mexico, and we're going to postpone them for 30 days. And so there's a lot of flexibility, and there's a lot of give and take. And we know already that a few senators, Republican senators, are pushing back against tariffs. So we'll see how it plays out. But we think the market is right in not giving it all that much credence. I know within the market you can find some traces of concerns about how tariffs might impact certain companies, but the overall tariff issue isn't bad. Meanwhile, as we wrote in our note this last night, the China stock market and the European stock markets have outperformed the U.S. stock market so far this year in local currency. And our take on that is a lot of that has to do with the potential of a ceasefire between Russia and Ukraine that has gotten the German stock market and other stock markets in Europe moving higher. And then I think there's been a lot of volatility in the Chinese market, but the Chinese government has kind of tried to reach out to stock investors. And now, yesterday, there was a meeting between the Chinese government officials, including the Xi, and entrepreneurs, and they try to kind of make things better. You want to add anything else, Eric, or should we move on to the charts?
No, let's see
Okay,
the chart.
then we can leave some time for discussions here. So let's go to the charts. By the way, I did a Zoom call with one of our employees, David Yardeni, who is related to me, and we were talking about some family things, and we talked about some business things. And before that, I just was tooling around with the Zoom desktop, and I pressed on the artificial intelligence button, and it came back with a very accurate read of our conversation. It was actually a little eerie. I'm just trying to see if I can open both of us up here. There we are. Okay. Yeah, I was also toying around with that thing, but so Eric, let's talk about the gunfight at Doge City. There was a great classic in the late '50s called the gun fight in Dodge City. So that was the inspiration for Doge City. And we've also been talking about the Doge boys. The Doge boys are scrambling, and they should scramble because the Democrats are out to get them. The Democrats are out to send many attorney generals, Democratic attorney generals around the country to file cases to stop the Doge boys from doing what they're doing. And so there's a sort of a gunfight going on there. And there hasn't really been a gunfight yet between the Doge boys and the Bond Vigilantes, but it's something that Scott Bessent, the Treasury Secretary, has alerted the president to, and of course has probably talked to Musk about it. That they got to satisfy the bond market, because if they don't, the bond market is going to get in the way of whatever plans they have. But of course, we did see some clue of that in the financial markets when the Fed lowered the Fed funds rate by 100 basis points because they thought the economy was weakening, because they didn't want the unemployment rate to go up. They kind of misread the economy, and they kind of said, oh, inflation's close enough to 2%, so we can just focus on unemployment. And ever since then, the data has confirmed that our view that the economy is resilient, it's growing, and that inflation isn't quite where they want it to be, and that it might have been a mistake to lower 100 basis points. But it is what it is. They've done what they've done. And meanwhile, the bond vigilantes and both in the 10-year and the 2-year, were signaling that that was a mistake, because they dropped 100 basis points and this went up 100 basis points. So I would say it's sort of a bond vigilante signal. Bond vigilantes, the idea is that they're complaining about monetary policy being too loose, not being considered enough about the inflationary situation. Here's another interesting chart related to that. That shows the federal funds rate, and everybody's got this federal funds rate chart versus recession lines. In this case, we got it versus presidential fourth-term presidential cycles. I think I made a mistake putting that in that way. What I really meant to do was put in recession shades, so that's on me, my fault. But if we had recession shades in here, you'd obviously see that the federal funds rate tends to go up before recessions. Then it peaks as the tight monetary policy causes recessions. And then they have to lower interest rates dramatically. This time around, there has been no recession. And so it's questionable whether they had to do this, but they've done it. But they certainly don't have to do what they've done in the past when we've had recession situations. So we'll put in the right chart in that one. This is just the federal deficit. This is what the Doge boys are dealing with. Eric, give us a little bit of background on what Musk said he could do and what he thinks he can do, and what we think.
Yeah, he came out of the gate thinking he could shrink the deficit by $2 trillion, I believe.
Yeah.
And then I think he cut that in half at some point. And I don't know. I mean, I've been kind of following the Doge cuts, I suppose, and they're very at the margins kinds of things. They're not like
Mm.
based cuts. A lot of this are like mandatory spending, right? It's like
Yeah.
Medicare, Medicaid, Social Security, defense. I do think this push to get the EU to actually spend fiscally and spend on their own defense is a way of achieving this, but like I'm not really entirely sure what Doge is
Yeah.
doing in terms of broad-based cuts, but they are cutting the deficit in some ways. You know what I mean? So
Yeah. Well, again, we're not talking about the goal of balancing the budget. We're talking about a goal of reducing the deficit from 6% of GDP to 3% of GDP.
mhm.
And the question is that doable? And let's look at a couple of charts here. This is what you mentioned before about this is total outlays over $7 trillion, but you can see that 6 trillion of that is mandatory, and we're including national defense and mandatory. As you said, Eric, if the European Union is pressured to increase their defense spending, maybe we can cut ours. And the president in in one of his sidebars of his, which happen all the time, he said that maybe we should cut defense spending in half. If kumbaya, if the rest of the world does the same, but that's not the world we live in. And so, even if the Europeans spend more, I kind of doubt that we're going to be in a position to actually cut because the world is just not that safe a place. This is the discretionary spending, and it's around $1 trillion. So it would be kind of nice if we could cut something out of that. But assuming that you can just eliminate $1 trillion of discretionary is very naive. It's not going to happen. And I don't know that the administration is naive about it. I think they always like to bluster and take maximum positions and then see how the deals work out. We know that this is something they can't make go away, and that's the interest costs of the federal debt. This is a chart of the U.S. government federal budget deficit relative to nominal GDP. And this is what Scott Bessent said that he wants to accomplish. He wants to go from 6% to 3%. He never quite specified over what period of time, but I presume over the next 4 years, want to get it back down to 3%. Question is that achievable? I mean, last time we were down at 3% was right before Trump came in, and then Trump in 2018 cut taxes, and that got us up to about 5%. Then let's just ignore all this and kind of come back to normal times here. And what's not normal is the tax cuts combined with Biden's spending has led to deficits of 6% of GDP. But on a chart, it just doesn't look that unachievable. It looks like it's conceivable,
Yeah.
but something's got to give both on the outlay side and on the taxation side.
I
So
mean, when you split it out, outlays are like 24% of GDP right now, which
yeah,
is historically high. That's like a reset outside of COVID, that's like recession levels of spending. But and for everything about tax cuts, I mean, revenues as a percent of GDP mostly bob around the high teens, 16, 17,
yeah,
up to 20%. So I think, regardless of extending the TCJA, revenues probably just assume they kind of stay steady. They historically do. You got to get 24% down to something like 20% of GDP for outlays, and that's
mhm,
probably how you get there. So it's historically normal, but they just have to rein things in to some degree.
yeah. Well, we'll see. It's in the hands of the political process, and you got to be impressed. The founding fathers did an amazing job of creating systems of checks and balances that we now fondly call gridlock. And the damn system gridlocks on a regular basis, and it's pretty hard to get things done unless you want to increase spending and cut taxes and kind of trade that. That's what Democrats and Republicans have done. But going the other way is not so easy. Well, so maybe it'll take a debt crisis. Ray Dalio is going around writing a book about how countries go bankrupt, and he's on LinkedIn looking really quite alarmist. I'm always amused by billionaires telling us how terrible things are going to be. I think when he got rich, there were a lot of reasons to believe that things were terrible. But anyways, let's not dwell on Ray Dalio. Let's dwell on what he's concerned about. And it's a legitimate concern. The potential for a debt crisis. Well, what does that really mean? It really means that the bond vigilantes just get completely and totally fed up. They conclude that this administration is another lost cause, another administration that is promising to do something about fiscal discipline and it isn't doing it. There have been previous committees and previous administrations that were assigned the task of uh, increasing government efficiency and transparency, and they weren't successful. Look where we are now. But maybe it'll take a crisis. Maybe what does that mean exactly? It means I think that the bond yield goes back to 5%, and then people like ourselves will say, "Yeah, it's a pretty damn good yield again. Maybe you should buy it here." But the bond vigilantes are not happy. They're not happy with the size of the deficit, the supply, and maybe we continue to get an inflation scare. So the Fed, everybody starts talking about the Fed having to raise rates instead of lowering rates. In that situation, we could get to 6%. I mean, that's if you ask us to define a debt crisis. And by the way, we have that in our scenarios. It's that 20% bucket with everything that could go wrong. So the debt crisis is probably the main issue that we have in that bucket right now. And one of the ways to kind of gauge the bond vigilantes is, if you will, a primitive, simple bond vigilante model is just to look at the nominal bond yield versus the 10-year bond, the nominal GDP growth rate, which is this blue line, versus the bond yield. And if you take the spread between the bond yield and the nominal GDP, you can see during the 60s and 70s, the bond vigilantes didn't exist. They weren't vigilant. They weren't born yet. They should have been, because Henry Kaufman and Al Wojenauer were going around warning everybody that things were out of control on the inflation side, and they were right. And people lost a ton of money in the bond market. And by the time everybody started to listen to Al and Henry, the bond yield was peaking. It was starting to come down, but there was still kind of a lot of fear about inflation. Suddenly, the bond vigilantes decided to be vigilant and kind of step up and push bond yields up if they believe that fiscal and monetary policies weren't disciplining the economy, weren't keeping inflation down, and weren't keeping economic growth from being inflationary. So we had a few episodes here where the bond yield rose above the nominal GDP growth. And in those episodes, nominal GDP growth did in fact slow down. So the bond vigilantes did have an impact. In the early 1990s, Clinton was warned by his advisors not to mess with the bond vigilantes, and he actually practiced he actually developed fiscal discipline. We were in a surplus by the end of the 1990s into 2000. This period you can't really say much about, because between 2008 and between the great financial crisis, the great virus crisis, the Fed was rigging the bond market through QE. But the market has been liberated, if you will, and here we are with the yields back to normal. 4.5% is where we were before the great financial crisis. So we're kind of back to where we were. But I think there is a potential, and Scott Bessent has acknowledged as much, that the 10-year bond yield is more important than anything else. And that's partly because the bond vigilantes have never, ever been more powerful, because there's just so much debt out there that that has to be refinanced, and that additional debt that has to be financed. So Eric already went through the retail sales numbers for you. This, I think, is a fun chart. It shows the monthly data, seasonally adjusted and not seasonally adjusted. And you can see that we've been making higher highs and lower lows even here. But the seasonals didn't adjusted properly in our opinion, and so we think the consumer's okay. This is what Eric mentioned before on retail sales versus the Red Book number. The Red Book number is weekly, so it's a good way to kind of monitor things, and that looks okay. This is the weather and people who were not working because of the weather, so the weather was bad. And there's another bad weather chart here. That's this one that Eric mentioned in terms of utility output. Eric, why don't we open it up for a little Q&A and see what people are thinking about?
Yeah, so we have one in the queue. Everyone feel free to add some more. We have some time here. So this first one from Chip is on Scott Bessent's 333 formula. Do we buy it? Do we think the bond vigilantes will? And for a reminder for everyone, it's getting the budget deficit to 3% of GDP, achieving 3% real GDP growth, and then increasing energy production by 3 million barrels per day.
Well, it certainly worked in getting Scott Bessent a job with Trump. 333 is a nice, clean way to market a Trump policy, and 3% growth sounds good. And by the way, we've basically been around 2.5%, 3%. We got no problems at all with 3.5%, maybe 4% over the second half of the decade in this roaring 2020s productivity-led environment. Then the question is, can they reduce the deficit from 6% to 3% of GDP? So we kind of went through there, and a little bit on the skeptical side, but it's not unachievable. It wasn't that long ago that we were at 3% of GDP, but whether there'll be enough discipline to get us there. And as Eric said, so far it's hard to, unless anybody share a running total with us if you got it. But it's hard to really assess whether the cuts are nickel and dimes, or hundreds of dollars or billions of dollars, or it's certainly not going to be $1 trillion, right, Eric? I don't think we.
Yeah.
I think Musk is going to have to. Musk has a tendency to overpromise, but eventually he does deliver. So don't let's not underestimate what he might be able to do. And then finally, can they deliver another 3 million barrels per day? I guess they could. The problem is that with lower oil prices, which would take the incentive out of producing 3 million barrels per day, I think again he needed to market it, and 333 is marketable. I think somehow expressing that you want to keep oil prices low and stable, and I think that's kind of where they are right now.
Yeah.
Manageable and stable would be a worthwhile cause. But I think lowering the price even more is very Reagan-esque. Reagan figured he could put Russia out of business by dropping the price of oil, so he got the Saudis to produce more. And of course, that would also defang Iran without having to bomb their nuke sites. But that's still an open question. Eric, go ahead.
This one is from Chris. What's our position on how any potential peace accord between Russia and Ukraine would impact U.S. energy exports in terms of oil and natural gas? Germany is obviously a big importer of Russian energy.
It's funny. I was thinking about that last night, just before I went to bed. Seriously, I mean, I was thinking to myself, well, wait a second. If the U.S. is now going to dictate terms to Ukraine over what peace they've agreed with, bilaterally with the Russians, and peace unfolds, forget about the appeasement issue, which is hard to forget. What does that imply? Does it imply that suddenly Russia is back to the fold of civilized nations, and the Germans become dependent on their gas again? I hope not, but anything's possible in this crazy world of political dynamics and geopolitics that are head scratchers. You got anything to add to that, or?
Yeah, I mean, and I think it goes with the 3 million barrels per day. Don't think about it as oil, but energy broadly. I mean, there's a good chance that whatever, Vance's comments at the Munich Security Conference and whatever the EU does to counteract or help rebuild Ukraine, they're probably going to import more American natural gas.
Yeah,
So
I would think the U.S. would significantly scream at the Europeans that they're doing it again, becoming dependent on Russia, and that
yeah.
we can provide them with all the natural gas they need, and we could even give them some oil.
Mhm.
So yeah, I think that's true. But right now, let's give peace a chance is what's going on in the European stock markets. Of course, they're completely ignoring the fact that in April they could be slapped with reciprocal tariffs, and that could be a whole nother issue that the market has to deal with over there. Go ahead, Eric.
Yeah, there's a bunch of questions about the 10-year yield, basically like what can Trump and Bessent do to lower it?
All yours.
Yeah, I mean it's basically what we've been talking about. You get lower energy prices, you get lower inflation expectations, lower yields, and then if they do manage to rein in the budget deficit in any shape, way, or form, you're going to get, maybe yields don't plummet or drop dramatically, but you're definitely going to get that risk of getting to 5% or above dramatically reduced. So it's if they achieve those goals, the lower 10-year comes along with it. They don't need to like twist or get the Fed to twist or do anything like that.
Yeah, I mean the bond market's held up in a very quiet, stable fashion here. Even with the inflation news recently being hotter than expected, and with retail sales being weaker than expected, maybe the bond market just canceled all those things out. But it certainly looks as though the interest rate environment, and I may be about to jinx it, is kind of background noise for the stock market now. It's more earnings, it's more tariffs and things like that. Why don't you just take the last question from Gus?
Yeah, it's a good one. So we saw a rise in used car prices and car insurance. Used cars increased based on higher demand in areas impacted by flooding and fires, potentially. And then car insurance got that annual price reset. So how long does the quote unquote noise for items like these last?
You got an opinion on that, Eric?
Yeah, I mean, I think there's always been some issue with slicing and dicing the inflation data too much because it's always a story of aggregate demand. So if you keep looking at specific categories, you're just going to miss it when it goes to another category the following month. January is always noisy. Price pressures always increase in January or have been in the post-pandemic period. I think as it's going to depend a little bit on tariffs and autos production, specifically with respect to autos. We saw one of the charts in this briefing was a huge drop off in autos production last month. But broadly, I think we're kind of steadying out at a little sticky, too high of a level. But I don't think inflation's reaccelerating. I think we'll just see some categories that are kind of hotter than they otherwise should be, maybe for the rest of the year.
I think you meant a big drop in auto sales, not production, right?
Yeah.
It was the sales number, and that was after there were all these discounts that really
Mm-hmm.
boosted car sales at the end of last year. So, it is noisy data of late, but looking through thick and thin, we think the economy is resilient. We think a lot of people who didn't appreciate that over the past 3 years don't seem to appreciate that now because they're all concerned that tariffs and you know policy chaos coming out of Washington is going to depress the economy. But let's not underestimate the power of the economy that's really driven by working stiffs like us. We spend so much time focusing on Washington, we forget about the fact that the economy has its own dynamics, and the private sector somehow manages to do pretty well, notwithstanding Washington, one of our themes of late. Eric, thanks for joining, and thank you all for joining, and we'll see you next week. Have a good week.